There we go. Okay. That should fix it. Let me try that one more time. We should be live now with sound. Let me just check with my team, and we're good. How about now? That should be good. Still working out the transition to Mac. It's fun. I will get there. Okay. Yep, just thanks, Kyle. Just double check. Let me know everything's good, and okay, we'll get rolling. Okay, thanks. As I mentioned, Kyle is going to sit this one out. We came down with a nasty sinus infection after traveling. He was here for 2 weeks. Him and his wife and family. It was great, new baby, and he's kind of hurting. So all good. Rest up, feel better, Kyle. It is Thursday, the 24th, and I think we got a good little presentation for you here. Markets are, kind of quiet actually, but consolidating on the highs. We'll talk about tariffs. We'll talk about earnings season. Tesla and Google out last night. We're going to talk about where we are so far. 7 months, almost 8 months done with 2025. So we'll get in and out. Hopefully have a little bit of fun here. And let's do this. Okay. Okay, here we go. So again, I'm going to be flying without Kyle today. That's all good. Okay, same thing as always. This little part of the presentation is going quicker and quicker each time. We at Inside Edge Capital, we're a full service wealth management business, active portfolio management with comprehensive financial planning, but we also sort of borrowed a few pages from our old life, my old life at trading analysis after 13 years. We do offer sort of a membership option to follow along one of our portfolios, which is Active Opps. It's our most active, aggressive portfolio. We partnered up with a company called Savvy Trader. You can follow along as I manage the portfolio live. Okay. It's crazy cheap, $300 for the whole year. Not even trying to make money from it. So that's that. Okay. We also, and it looks like I took one of the slides out, which is fine, but as a full wealth management client or sort of the hybrid portfolio investor, you get access to all the portfolios, financial plan. You can go down a more, I would say, comprehensive membership plan as well. So any questions, reach out to us. But let's get moving. We are coming up on the Fed July 30th. So that's going to be next week. We are 97% chance of no cut, but we're about 64-36 for a cut in September, and that very much can change. So we'll see. We're coming up on the 90-day tariff deadline. We're going to see. It's all about the deal with China. Can they pull something together? Is it going to be further extended, as CNBC reports from Besant? Market seems to be discounting that some kind of amicable solution or the can being kicked down the road is going to happen again. It doesn't seem to be rattling the markets too much, and they seem to be, that's the portfolio. That's the part I was missing, but that's okay. Doesn't seem to be rattling too much, and it seems to be more trading on earnings. What's going on in Saratoga? We usually throw something fun in here. There's two things I guess I could report on now that Kyle and family have gone home. First thing is we have our last baseball game, the first game of our last tournament of this season that began in January tonight. I coach the travel team in town here. My assistant coaches are going to run the show. I'm not going to be there tonight because we're going to Seinfeld at SPAC. Why not? My wife said I have to be there. Our friends are going to be there. Can't wait to hang out with all of them. I hate to miss the baseball game, but we're going to do dinner we're going to do Seinfeld. I just got an email from CNBC. They said, can you be on at 6 a.m. tomorrow morning? And I said, no way. Thanks so much. I will be a horrible guest tomorrow because I'm going to be out too late tonight. So that's what's going on. I always try to put something fun every week to just show you what's going on in this very fun town that is Saratoga. All right, so earnings season is underway. So here we are on Thursday. After the close, we are looking at Intel, Deckers, which has been a very good one. We had some busy earnings. We'll talk about later on Tesla as well as Google, ServiceNow, Chipotle missed, IBM's driving down the Dow. T-Mobile kind of crushed it. T-Mobile is very interesting on the cellular comm side. And then, looking out till, as I said, after the close, and then a few tomorrow morning. But then we're going to pick back up Tuesday with Spotify, which is a large holding that we have in two of the portfolios at Inside Edge. UNH, another very widely followed, Procter & Gamble, Boeing, Merck, AstraZeneca, or AZN, Visa, Starbucks, Booking Holdings after the close Tuesday. Not AstraZeneca, you know what I'm saying. Big one will be Wednesday, Microsoft, Meta, and Qualcomm. Those are going to be huge. Wednesday, that is also Fed Day, so that'll be interesting. And then next week, Amazon, Apple, Coinbase, MicroStrategy, especially everything that's going on in the crypto space, with all the attention on Ethereum, Tom Lee's new product that kind of tracks MicroStrategy, but the Ethereum version. I just read somewhere they're holding $2 billion worth of Ethereum, which is insane. KLA, Tencor, Stryker, Chevron, Exxon, and LIN. Okay. Google, let's kind of spend some time on Google if we can. Google, let me just stretch this out a second here. Google crushed. Where'd my cursor go? There we go. Google crushed top and bottom line. Revenues expected $87.94 billion, came in at $96.4, which is almost a 10% top line beat, which is kind of crazy. EPS expected $2.16, put $2.31 down. You could see the spread between expected and actual reported, not as big as the beat last quarter. Here's the after hours reaction in Google. Even though I'm not a day trader or really a swing trader or really even a position trader anymore, I always like to watch the near term just to see how the market's voting in reaction. This is a 15-minute chart of Google over the last couple days. Here's the earnings reaction. Initially, we went down to about $1.84, traded back up after hours during the conference call. And then this is in the Asian session. Probably Europe comes in right about here, London, and then the New York session opens, profit taking. And then we've stabilized right above where we reported, which, when the numbers hit was right here. So net after this big round trip, Google's up a bit. And there's some interesting stuff in here I wanted to look at. Some highlights that I've pulled from Earnings Hub. AI integration right here. The company is at the forefront of AI development with AI positively impacting segments, features in search and YouTube. And this is so interesting because so many people are calling for the end of Google search and AdWords, which is only possible because of search, really, because of ChatGPT and other upstart AI competitors. But we're kind of seeing a different story happening here. And I was kind of growing bearish on Google. I reduced our allocation, still hold it, reduced it, but thinking again. AI features in search and YouTube are driving engagement, revenue growth, AI overviews, leading to a 10% increase in queries. YouTube performance, cloud growth, Google Cloud, operational efficiency despite rising costs, and we'll talk about this. Alphabet's operating income increased by 14%, and they create about $5 billion in free cash flow right here. So I looked at that, maintaining a healthy cash position with $95 billion in cash, generating $5.3 billion in positive free cash flow. And then the number one negative that Earnings Hub AI came up with is rising costs. Total operating expenses increased by 20% due to legal charges, higher depreciation costs, and they also invested in more AI infrastructure, which we're going to talk about. So look at the chart though. You look at Google on the weekly going back to 2020, big old rally. We sold off here in the tech growth sell-off at 22, 23. Did sort of a triple bottom here, moved up, broke above resistance. Resistance is now support once. Tried it again here in the beginning of 2025. And here we go, just recently, Google coming on. And those of you who, are technical analysts or studied anything, a pattern that's got a higher high and a lower high could sometimes be referred to as a head and shoulders pattern, which I find that they fail more often than they work. And when they do fail, failure would be a break above the all-time highs. A lot of times it's a trend continuation pattern, right? And I included, this is going to be EPS and expected earnings after the dotted line, and this is historical earnings and sales. So you look at the percent growth, the company in 2023 on GAAP earnings made $5.80. In 2024 made $8.04, which is a 38% increase, which is crazy. And then expected in 2025, $9.77, 21% growth. And then for next year, up to $10.26. So you've got overall annual EPS, GAAP EPS growing 27%, 38%, 21%, 5%, with top line revenues growing 8%, 14, 11, 10. And that's with the ongoing threat of ChatGPT. So, the combination of technicals with possibly a failed reversal head and shoulders pattern combined with pretty solid top and bottom line growth year over year makes you want to kind of think about this. So the one thing that I mentioned is they generate about 5.3 in free cash flow. And when I looked at this, I said, boy, that kind of seems low to me. And here's the actual quarterly free cash flow charted all the way back to early 2022. That's the lowest free cash flow that the company has generated in years, right? The expectation, okay, this is what was just reported, right? For Q2 of 25, this will be Q3 of 25, Q4 of 25. Analysts are expecting free cash flow to reaccelerate. And I think we got to watch this, okay? On top of that, and I'll tell you why, or why I think at least, but then you look at what kind of free cash flow on the annual basis they're generating, 72 billion, 87, 104. Look at the expected free cash flow that they're looking to generate even with massive investment in the hardware for data center servers, AI hardware, networking to support growing AI and cloud infrastructure. So, what I'm thinking about this, so in Q2, Alphabet spent $22.4 billion at CapEx, 70% year-over-year increase from $13 billion in Q2 of 24, same quarter last year. So that's why the free cash flow was so low. And the fact that the stock initially sold off, rallied sharply after hours, kind of put in a double top here, sold off a bit on the open today. The black is going to be New York Stock Exchange session, and then the gray is the overnight 24-hour trading. But the fact that they had the lowest free cash flow in so long with such a big increase in CapEx for AI spend, and the market is giving them a break, combined with this expected free cash flow generation, which we'll see what actually happens when they report Q3, that kind of tells you there's something more than ChatGPT really threatening the business model of selling AdWords for advertising and search queries and stuff like that. So I kind of thought that was interesting. Q2 earnings overall, how are we doing? This is right from Tom Lee. Again, this is a premium subscription that I do pay for from Tom Lee, and I'm not really supposed to screenshot this. Sorry, Tom. As I say, I fully endorse and recommend his research. It's top quality. I've subscribed to it for years. But here's a breakdown of what we've done so far in Q2 earnings. So 27% of the S&P 500 companies have reported, which is 134 companies. 85% of them are beating estimates, and those that beat are beating by a median of 4%. Of the 15 that are missing, they're also missing the expectations by 4%. All right. So what that means, if the analysts are looking for the company to make $1 and they beat, the median is they're reporting $1.04 in earnings, and then if they're missing, it's 96 cents. On the top line for revenue, results are beating by a median of 2% and missing by 2%. So, not crazy. What's the takeaway of this? Analysts, I think, are usually low in terms of what companies are earning, especially in bull markets like I believe we are. So, you got to look at the margin by which the majority of companies that usually beat, how much did they beat by? And, this is like equal on the upside, equal on the downside. So it's not like a table pounding. This has been extremely strong earnings season. It's good, but it's not massive. And again, we're only 27% of the way done. All right, so there it is again. 85% of the 27% companies that have reported have beat, and the surprise is 6.4. Now I'm not sure. Okay, that might be the average, where that's the median. 6.4% beat. And then you can look down and say, what kind of companies are surprising the most? Well, financials are actually 11%, those that are beating. Consumer discretionary, technology, and those are the main sectors that we look at. Okay. So what I thought to do here is let's just take a look at, as the stock market, and we'll look at the averages, the technicals of the market. I was like, let's take a look at where the sectors have been since Q2 earnings season began. Okay, so the S&P 500 is highlighted here, and that's what I refer to as the benchmark, right? And let me just take a second here and let me just kind of address the team here. Okay. It's important. I think those of you who are traders and who followed me in the old life probably already know this, and it's a good review. But those investors who didn't follow me in our very active trading days, and this is new, this is just something that I think it's important to know. So when you look at the averages, and I know a lot of people like to look at the Dow Jones Industrial Average, which is 30 stocks that are most representative of the American economy. And the way the Dow Jones is calculated, it's price weighted, meaning the more expensive a stock is, the more impact it has. IBM's a very expensive stock. It's having a pretty big downward impact on the market today, even though everything else is up. The S&P 500 is the true way to look at, that's the true barometer of the American stock market. And the way we look at it, and the way I manage the portfolios at Inside Edge is, it breaks down into 11 sectors that make up the American economy. So it's technology, consumer discretionary, communications, industrials, healthcare, staples, utilities, materials. I forgot them all. I was going to try to list them all, but you get the point. We're going to list them on the next screen. But the way I kind of look at the portfolios is I look at what percent of the overall S&P 500 is represented by technology, right? It's about 33, 34%, 30%, 34%. It moves up and down in there. Communications, I think it's 12, 14%. Consumer discretionary, somewhere around 16, 17, 18%. The financials, I think it's around 10, 11, 12%. The utilities and industrials and healthcare, staples and financials and all that. So it has different weightings. Like the materials, I think, is only 2-3% of the American economy. So obviously you're going to be more underweight materials. So you want to look at how those 11 sectors, I forgot real estate as well. You want to look at how those 11 sectors, make up the overall 100%, the whole pie of the S&P 500, and how those sectors are doing. And the more offensive sectors, the ones where we see capital flows into, and upswinging economic times when views are good that the AI boom, technology is continuing to go, the consumer's healthy, is spending. The more offensive sectors that, again, we'll see capital flows when things are expected to be good are going to be technology, consumer discretionary, and communications. Communications has Google and Spotify and Meta in there, right? And then there's somewhat more cyclical sectors that don't just kind of trend in significant bull markets, but they kind of go like this as the overall economic cycle goes like this. So there's a group of 5 or 6 of them in there, and then the defensive are going to be names like utilities and healthcare and consumer staples, right? So it's just kind of important to see how we look at the overall American stock market, the 11 sectors that make up. Each sector has a certain job in the market in terms of capital flows based on what investors are thinking is going to happen in the future. Now, what's interesting is we're going to go in the next slide is those lines are being blurred a little bit by some of the safety or defensive sectors because of the AI build out, which is specifically utilities. We'll look at that. So on this side, I just wanted to look at how we're doing, how the sectors are doing since Q2 earnings began, which again, we're only 27% of the way through. So sorted by 10-day change, okay, which is when Q2 earnings began, real estate is actually doing the best. 2.77% is the improvement in the XLRE. I think a big part of that is going to be interest rates, which have stopped going up. I didn't include a chart in this, but just take my word for it. The U.S. 10-year yield has stopped moving up and has started going down. A very clear relationship between real estate stocks and U.S. fixed income market is that of the 10-year yield in real estate. Okay, so we're starting to get a little bit of a bid in bonds, which means interest rates down. Utilities. Now you could say, all right, well, utilities are traditionally dividend-paying stocks with not a lot of volatility. But as I mentioned, the lines are being blurred right here because you might get something of an inverse move against interest rates. But I think when you look at communications in third place, industrials. And then this is just large cap, XLG. There's the NASDAQ, and then there's technology. So you've got technology, industrials, communications, and utilities are, second, third, fourth, fifth place for Q2 earnings season. I think that says more to, that the AI build out, because as we'll go to in the next slide, utilities. There are some utility stocks out there that are performing like growth stocks with power generation to fuel the AI build out. Industrials, a lot of it is the actual physical infrastructure for increased power demand and these data centers. You need a lot of nuts and bolts and hardware to build this out. So those guys are leading tech, which is QQQ, XLK is a technology ETF. There's the S&P, financials, consumer discretionary staples, small caps, healthcare, materials, and energy. Okay. And then if you go over here year to date, same group of sectors, even though we're seeing a little bit of a pause here as the market's consolidating, I think we got to keep in mind that, the S&P is up 8.3% for the year. The NASDAQ's up 10.4%. Utilities up 11.6%. Technology up 12.2%. Comms up 12.4%, and then industrials, which are still the best performing sector of the year, up 16%. This is all AI build out here. And this is the line being blurred between the normally defensive utility sector now being sort of traded like a growth stock because the power requirements for the AI data centers are massive. I listen to some, I think pretty smart people, and they're saying 20 to 30% of power consumption in the U.S. in a decade will be from data centers, processing data. It's crazy. So here's kind of a fun graph, just looking at the S&P 500 and the NASDAQ sorted year to date. Let me see if I can zoom in on this for you a little bit. And just what you want to look at is, let's look at the S&P. Obviously, you want to look at the company name, but then look at the sector that I just described to you. Tech, utilities. Palantir, no surprise, up 104% this year. Here we go. GE Vernova, up 88.3%. And it's crazy. Like, I actually used to coach the CEO of GE Vernova, used to coach his kid in ski racing. He spends a lot of time here in town. But GE Vernova up 88.3%, which is power. NRG Power, 77% utilities. Seagate, Supermicro, that's hardware for data centers, 73%. Howmet Aerospace, the aerospace trade is going crazy. There's some names in there like Joby, AVAV, Howmet Aerospace. There's just crazy things happening in space right now as Elon's pushing that. Some of the materials are doing well. Gold's doing well. Newmont's up 64%. There's GE, Coinbase, Royal Caribbean. There's some I think that's the second consumer discretionary. Tapestry, I don't follow that company, but Royal Caribbean, Mosaic, Uber is an industrial, and then on down. So it kind of just goes to show that it's not all tech leading. And it's kind of a diverse market right here. And you look at the percent gains for the year, 100, 80, 70, 60s. I think it's striking when you get over here to the NASDAQ. Palantir, also the NASDAQ, 100%. But look how quickly you get to the 40s and 30s and 20s in the NASDAQ, where in the S&P you've got 70s, 60s, 50s, 40s. There's a lot more companies that are up more this year that are not technology. So yeah, it's great to say we're in a huge growth trade, but some of the biggest returns have been outside of that. And the way we run our portfolios, as I was starting to describe to you, is I'll pick, the best 3, 4, 5, 6, 7 stocks within all 11 sectors that would go into the portfolio. And even in our growth portfolio, which is TAG, we have representation by all sectors. Right, but there's data center real estate companies. There's utilities that are that are being bid up massively because expected increased power consumption, and industrials that are going to build the infrastructure behind it. And then of course semiconductors like KLA-Tencor and Lam and Broadcom. But it's not just a growth trade where you just want to be long tech. Like, there's so many different names from different sectors that are putting up some real performance this year. So I guess the point is it's a fun bull market. And the fact that I don't see concentration in one group or the Mag 7 leading it. Do you see Mag 7 leading this year at all? Like, there's not even a Mag 7 on... I guess I don't even know if Netflix is still in it anymore, but that's the first one that would even resemble a Mag 7. So the leadership is broad this year. Right? I take that as a very good thing. There's Meta right there at 22%. There's Nvidia at 28%. There's Netflix at 31%. So it's a different market now, and I think that's very good. All right, so those of you guys from my old life, here's a little down and dirty Elliott wave. If you don't know what this means, don't worry about it. If you know me from my old life, well, the way I look at this is, and this goes all the way back to the days of Charles Dow and basic Dow theory, markets advance in trend phases of 3: accumulation, widespread participation, and then what they call distribution. Well, Ralph Nelson Elliott in the 1920s, 30s, 40s, and 50s took it multiple levels deeper and assign different expected values and starting stopping points and labels along the way. Well, these horizontal lines are ratio targets based on the prior swings, and it's not an exact science at all. It's more of an art. But a lot of times you'll see when you get a clustering of these lines with the patterns that the market will respect it. So on the NASDAQ composite, the fact that we got through 18,000, we went up there in 24, sold off in 25, the first quarter of this year, and here we are again. That was all around this first clustering at 18,000. The next clustering is not till 26,000, right? And I would be shocked if we got to 26,000, we didn't see some kind of respect or sell-off like we saw earlier 25 at that zone. But 21,000 to 26,000, that's another 25 or whatever percent. 21, 5,000 points as a percent of 21,000. It's going to be about 25% until we see some kind of sell-off. That's not a forecast. It's just using this Elliott model that's been well documented in the past. Now, the next clustering of levels, not for another 5 to 10 years, is up here around NASDAQ 50,000. Okay, so that's not a forecast. I'm just telling you what the price action is telling us based on the rules and guidelines of Elliott. So if you just kind of snapshot that in your mind, 26,000, 20,000 in the NASDAQ composite, each bar back here was 1 month of price data. Now we're going to go to a smaller weekly time frame. So here's the 2022 sell-off. Here's 23, 2024. Here's the sell-off that we had this year. We've done one of the most amazing V-shaped recoveries, which I am so shocked how sharp this recovery has been. And what's interesting is I had a call today. I'm sorry, it's dark. That's all right. I had a call that I've had 100 times. It's just this super nice lady. She was in California. She called me. She's like, Todd, I've been following you for years. I've got money I've been sitting on, and it's just time that I kind of give up, all the doom and gloom that just consumes these, the headlines, both in traditional and social media. And she's like, I just need someone who's going to keep an eye on it. And I'm kind of picking on Elliott Wave a little bit. There's so many who are saying this is, a 5-wave move and we're going into significant crash. And it's not just Elliott. It's so many people are trying to capture your attention. And she's like, there's so much money that's been left on the sidelines. And I think, the V-shaped recovery that I just described in the beginning of 25, and then here we are now, there are so many people who still don't believe it with the tariff overhang, with Trump being so unpredictable and Trump being Trump, and obviously geopolitical pressures. There's so many people who are still underinvested in this market. And just this lady was wonderful. She's awesome. She's got a good size account. She's like, I've been following you for years, Todd. I know you're running money. I'm sick of missing out. She's like, just take it. And we're going to obviously vet her and go through financial planning. But I'm like, join the club. You know how many people we've talked to who are really intelligent, are very successful, and accumulated significant wealth in other industries who just get sucked up in the emotions of, but the predators out there who are trying to scare you and win you to their way of thinking to service their own selfish purposes. Fear sells. If it bleeds, it reads. And that's just caused so many people to be underinvested. And again, when you put that technical V-shaped recovery, it hasn't let anybody get back in the market. So what that means is any little sell-off in the market is just quickly bought up by people who've missed. And I think there's a lot of people, both individual retail, who I'm describing, as well as big hedge funds, who are still not invested in this market yet. And the earnings, as I showed you, are only 27% of the way through Q2 earnings season. 85% of companies are beating their estimates. Are we beating the estimates by enough? We'll have to see. But I think there is a I think the train is starting to leave the station, and it could absolutely rip as we head into the back of this year, in the last 2 quarters of this year. I don't know. I don't have a crystal ball. I don't pretend to have one. But all I can do is say I sit in this freaking basement and watch the markets like I'm a day trader. And you just constantly watch, constantly reassess your positions, look at the markets, and you say, am I in the right position? And you just got to watch and filter and synthesize the data as it's coming in. And, if the facts change and the market starts to suggest something else, we're properly equipped with the tools to, quickly move the portfolios into a defensive posture and go. But I'm not going to try to get the top, and I think more people are going to continue to rush into those markets. So, the S&P up, what did I say, 8-9% for the year, whatever it is. I think it could turn out to be a pretty good year. We'll see. But if not, and I'm wrong, I'm going to deal with it. I'm not staking my reputation, my ability to foretell the future. Like, I work really hard to have a process to control the now. And I think that's what trading and investing is having a process in the here and now, listening to signs and clues and subliminal messages that the market's giving you, and then act on that. Set your ego and opinions aside and just listen to what's being told to you in the market through, macro and where, fixed income and commodities and currencies are going, where the equity markets are going. Is money flowing out of the U.S.? How's that sector rotation happening? How are companies how are companies guiding us going forward in terms of their earnings and their revenues and their CapEx specifically within this, and the behavior of customers? Like, it all factors in, and will AI replace us? I mean, they tried it with robo-advisors and they failed miserably. Will AI replace this? Maybe, but I don't know. This is a big, big psychological game. It's a big psychological chess game. It's not a game of numbers. So anyway, let's finish up here. Okay, I just wanted to leave this one up here. If you haven't checked out this keynote, it's amazing, talking about the adoption of AI and how big it is compared to prior cycles within the tech boom from the late 20th century into the 21st century. It's absolutely awesome. And yeah, that's going to be it. So, yeah, hopefully that was helpful. Let us know if we can help you at all. Any questions at all, insideedgecapital.com. We'll see how Seinfeld is. I have no idea. Is he going to be, we'll see. He's kind of an icon. It'd be kind of fun to see. Good luck to my baseball team tonight, and good luck to you in the coming week. Fed, Apple, Amazon. It'll be good. So we'll leave it there, guys. All the best. Talk to you soon. See you guys.